Hello and welcome back to All Things Money. I'm your host, David Blain. And in the last segment, we were finishing up talking about tax loopholes and deductions in this debt limit debate. There's a lot of banter going on from both sides of the aisle about loopholes and things like that. And I just wanted to point out that these are not loopholes. When GE pays no tax on $5 billion of earnings, it's because that's the way the tax code is set up. And the only way you're going to eliminate this sort of thing is to go to some sort of flat tax or some sort of consumption tax. I happen to believe that no matter what the tax rate is on businesses, it's always going to be passed on to the consumer. And so I personally would just assume do away with the corporate income tax because the consumer ends up paying it anyway. But the point is that if you take a deduction for your mortgage, that's not a loophole, just the same as if ExxonMobil takes a deduction for exploration and drilling credits. It's not a loophole. It's written in the tax code. And so I wish people could just move beyond that and understand that the people that we elected wrote the tax code, and we really have no one to blame but ourselves for the complexity of it. And you shouldn't blame somebody for taking advantage of something that is written in stone. What we need to do is go to a consumption tax where you pay a flat percentage on everything that's purchased, or some sort of flat tax, and do away with the 15 million different tax regulations. Anyway, okay, let's move on to the next subject. I want to talk a little bit about, as you know, my company is in the investment advisory business. We provide investment advice to high net worth individuals, and there's a lot of people out there that are promoting, investments or being a financial advisor. And I just wanted to point out some of the pitfalls that go along with this. This came out recently. There's a guy by the name of Ken Fisher, and this is not Ken Fisher is a good person. I read his books. He writes a column in Forbes magazine. But what I want to illustrate is he manages money. He manages $41 billion. He's probably one of the largest independent investment advisors in the world that manage money for individuals. You have to have $500,000 to work with him. But he has 40,000 accounts. Okay, so don't think that if you sign on with Fisher's firm, you are going to get anywhere near close to Ken Fisher. But anyway, this was about a lawsuit. This woman down in Florida, I think she was, Fisher's firm had to pay damages of $376,000 to Fisher's firm for breaching fiduciary duty to a retired investor. And this is what I want to talk about, the fiduciary duty to the client. This woman went to Fisher and they said to put 100% of your money into stocks. This was in 2007. These are people that are about ready to retire. We would never recommend somebody be 100% in stocks, frankly, at any point in their life, let alone when they're about ready to retire. The woman had no children, so there was no one to inherit the money. So essentially her and her husband had this pot of money, and they needed to start taking some to retire, and it needed to last their lifetime, but they had no one to leave it to. And so they put him in 100% stock. And in fact, fully 80% of Fisher's clients are 100% stock. And my point of this, bringing this up, is you need to work with somebody that can be flexible and take into account your circumstances, your risk tolerance, things like that when developing a portfolio. I mean, if you go to some of these firms out there, you're going to get, whatever they're selling. And in the financial advisors, a lot of them it's annuities. With Ken Fisher, it's this 100% stock portfolio. And so when you're out there looking for an advisor, make sure that you've got your eyes open and you fully understand what this person is doing. And so if you're working with a broker, you realize they have no fiduciary duty. It's just a suitability. And that if they make most of their money selling annuities, you got to realize that that's what you're going to get. You're going to get an annuity. If you go to Ken Fisher's firm, you got to realize that he's not going to do any planning for you. They're not going to do any type of personalization. You're going to get a 100% stock portfolio. It's the same across all his clients, and that's what you're going to get. nothing wrong with that if that's appropriate for you. But people just Fisher's firm did not do the best job, and it was not Fisher's firm; it was the salesperson that was in charge of this account. But at the same token, the person that gave them their money, they fell prey to the advertising and all that sort of stuff. And Fisher's firm is just not appropriate for what they do. Another example of this is Raymond James was hit with a $300 million ARS settlement, which is auction rate securities. These things back in 2008 were touted as, oh, they're safe as a money market and you make all this money, and, promoting them as safe. And so Raymond James and Citigroup, UBS, Wachovia, Bank of America, RBC, Deutsche Bank, TD Ameritrade, and in fact, Charles Schwab, the retail side, all these companies and their brokers have been fined for selling these type of investments to individuals by mispromoting what they were designed to do and what they could do. And so they, in this particular settlement, Raymond James, without admitting any wrongdoing, they never admitted any wrongdoing, but they always just pay the fine to sort of make it go away. But this is another example of, if you go to these firms where you have a broker and they sell products, you are going to get products that the firm is pushing, and it may or may not be right for you. It's going to be right for the, Wachovia or Wells Fargo or Raymond James. It may not be right for you. When we come back, we'll finish up with this topic and move on to some other things. But for now, let's take a short break. For All Things Money, I'm David Blain.